Welcome to StockOdds Odds and End podcast. I'm Dave Singh here with Rob Friesen, getting ready for the week ahead. Good evening, Rob. How's everything?
Oh, been busy day. I hope everybody took good care of their mamas. We're all here because at one time we had a mama. So even if you've lost yours or whatever, we have to be very thankful and respectful for our mothers. So it was a good day, and you know, let's get ready for next week here and talk about some. I think review a little bit of how we got to where we are at, because to me that's really important, is always context. And I've got a map of the market. Can you see it, Dave? Okay.
Yeah, it's on the screen.
Okay, good. So this is the 1 day performance, and we can see that Tesla, was a big factor in like mega cap not performing that well. Amazon down as well. Google stayed strong on Friday, but not as strong as it had been. But a lot of these mega caps were doing pretty good for the week, and then they kind of rolled over on Friday. So in a sense, they were kind of holding up the markets, is the way I looked at it. And it's very mixed. You can see kind of the stock picking going on. I don't, some of it has to do with some of the news that will kind of bring forward as far as what happened through the week. But it seems to be, like an example is, obviously PayPal, got hit in the payment area, and the other ones were holding up better. It had more specific news on it. But here you have Nvidia down and Avco up, right? Look at Texan, or how about Intel up, AMD down, for the day. So it just seems to be a lot of stock picking and sort of or rotating a bit into others. So let's roll this to the 1 week. And that gives you a picture of how we got here. Google, very, very strong, big driver. And other than Friday, Amazon was strong. Tesla was down for the whole week, but Friday was a factor in, of course, its total performance. Disney had some, some specific things going on. And I had mentioned to the BTM group about going short Disney and long Netflix on the prospects. And that was on the day before this meltdown occurred here, where Disney dropped a lot and Netflix rallied. So I brought that to their attention of potential opportunity. And I'm not in the recommendation business. I'm not an advisor, but I do see potential relationship-based trades out there. And we had an okay day on the oils on Friday. You can see they held in there okay, but for the week, oil was still soft, and that's kind of on this growth prospect. So as you look at this whole map, some of the news elements that happened during the week is why we've ended up with these kind of results. And so let's roll to the sectors here so you can see how they've done. Communication services, again, because of Google and Meta to some degree, and some of the other stocks in the communication sector, which isn't, flush full as you would have in financials or whatever. But that's why we came out on top for the week there. But you can see that it started to slip a little bit on Friday. And cyclical was also doing well for the week, but really got hit on Friday. And we'll explain why in a minute here. On the bottom of the pile, basic materials, it rose a little bit on Friday because of the US dollar actually creeped up. I found that interesting that it probably would have been a lot stronger had not the dollar, done that. But it was down in the bargain basement here for the week, but on Friday it did raise its head a little bit. So that's one area I'm looking a little bit forward on and saying I'm still keeping a close eye on the dollar and looking for this to really be strong if we get another good pullback. Because to me, that holding up there like that, in spite of the dollar's rally on Friday, that's a good sign to me. Okay, so it's kind of like that divergence, when you're looking at cause and effect and you see something that is an anomaly to what should or shouldn't be happening. That can help you dial into where it's like with the VIX. If the VIX was to suddenly rally, but the market's not selling off, or the VIX was to decline, but the market's not rising, these are tells, and you got to say, okay, well, what then might be going on behind the scenes? Something has to give here. You can't have that situation where volatility keeps dropping and yet the market's not really rising. Okay. So let's put it onto the 15-minute chart here of the SPY. This is for the week that we just had. And we'll roll back here to last Friday. You can see that we had this gap up and we had a really strong high signal type of a day on Friday, okay? Then you were expecting maybe we might see some follow through from that, or we might, just hang out. And we decided to kind of hang out in that mid range and traded mostly sideways all week from the open on Monday. But in doing that sideways action, there was a lot of reversals. You can see how much back and forth action we had. So why is that? Well, there's this concern about the debt ceiling, and that still persists. And the reason is there was a meeting on Tuesday that Biden had with the congressional leaders, and they're supposed to meet again on Friday, except that meeting got postponed until early next week. So there's negotiations still going on. We still don't have a resolution. And, this is still now a concern kicked down to the next week. And that might continue to go on. We don't know. But that is a definite concern for the market. I mean, there's been a lot of sort of really negative projections about what might happen if we do not increase the debt ceiling. And there's a big pushback about why do we keep doing this? Why are we in this cycle of continuing to raise it? Just, is this going to go on infinitum? That's the concern, right? So somebody has to push back, and that's what's happening. Another thing we had is we've got this concern about growth, and we saw that a little bit come into play on Friday, but it was back and forth for the week as well. So you want to keep your eyes on energy, because if growth is on the table, energy should rally. That's what you would think, right? And that can also pull up like discretionary and things like that. But if we're really concerned about growth, then we know that the consumer is going to cut back. We know that small companies aren't going to produce what is expected. Large companies might be fully priced in already and not much prospects above that. So then the other thing we had is this concern about the 3 to 5 year inflation that came out on Friday with the New York Fed survey of consumer expectations. So it's like the long range forecasts of inflation is still a little bit more elevated than was expected. It's 3.2% versus 3%. And that's the highest reading since 2011. But then there's also this expectation of, because of the CPI and the PPI numbers that we had CPI on, was it on Tuesday or Wednesday? Sorry. Wednesday, I think. Let me just check my notes on that. I don't want to mislead you here. Oh, yeah, Tuesday was CPI, sorry. Wednesday was PPI. So what happened from that is we got this sort of little bit better than expected, like things are working. Maybe there's no need for the Fed to raise rates in June. Maybe they'll be keeping the rate hikes on hold for the June meeting. So that's kind of what's in play there. So some of these rallies that we had can be attributed to that backdrop about, we just had the May meeting, things went kind of as expected. We were hopeful back in March and April a little bit, but then the reality set in, and yeah, it was kind of as expected. But now we're looking at June, and maybe they won't hike. Okay, maybe they'll pause for a month at least. And so some of these rallies are attributed to that. And the other declines are attributed to concerns about inflation, concerns about growth, concerns about the banking sector. Obviously, we had PACW really take it on the chin again. Let's just take a look at that. Things aren't going so well in that department there. So they've had some rallies, and they're stunning rallies when you've been down so much, and there's probably a lot of short interest, which we can see here as a percentage of the float, 17%. So if there was to be really good news that gained some traction and had some real legs, some real substance behind it, the shorts would definitely want to cover if this thing's going to go back to where it came from. So you can see the problem here, but still the regional bank concerns are there, even in spite of the positives that have happened along the way. So that's a bit of an overhang to the market as well. So I rattled it off. I think we covered debt ceiling. We've got banking still an issue. We've got the growth concerns, and then also one more. We've got the Treasury note this week here rose 7 basis points, and the 10-year rose 1 basis point to 3.46. So the dollar rose this week as well a little bit. So overall, again, interest rates still, showing a little bit of upside there, and you got to balance that again with what the market's expecting, and this push and pull, this tug of war constantly. All right, so we'll roll over to cover some things here Dave can talk about. Let me pull it up on the screen. The first thing is we've got some earnings this week here, Dave.
Yeah, so some big ones starting on Tuesday. A lot of it has to do with the theme of retail. So Tuesday, Home Depot is going to be a big one. And then on Wednesday, Target. And Thursday, Walmart. So that's going to give a lot of light in as to how the consumer is holding up. Are they cutting back? Are they feeling the inflationary bite and really changing their habits? And then Friday, John Deere. So that's more of industrial. So the Tuesday, Wednesday, Thursday are going to be big retail kinds of earnings. There's other ones as well, but those are the key ones. In terms of economic reports, we have not too much here. We have some Fed speak here and there. But Tuesday, U.S. retail sales report, industrial production, and on Wednesday, housing starts and building permits. Thursday, some jobless claims, and Powell's going to speak on Friday with Bernanke. So again, it's going to be how the Fed might pause or continue to increase rates, but it's really how's the consumer holding up, and
right.
how's retail doing. Those are the big themes for the week.
All right, I'm going to pop up copper here. Copper has been in decline because of the growth concerns, but we know that the world is still looking forward to, the world is still looking forward to alternative energy from oil, and that requires a lot of copper. And so we have a merger. Originally, Newmont bought Goldcorp. I interviewed the former CEO of that on one of the podcasts you can look for. And so he was with Goldcorp at the time, but now Newmont's buying something that's even bigger than Goldcorp. It's Newcrest out of Australia, and it's 0.4 shares of Newmont to 1 of Newcrest. There's also a $1.10 dividend, special dividend that will be paid to Newcrest shareholders, and this represents a 30% premium over the price that it's trading at now. On the OTC market, it's symbol NCMGY, and it's trading also on Toronto under symbol NCM. So what does this mean? This means that Newmont is increasing its stake of copper and of gold, both that Newcrest has. So Newmont's even becoming bigger. Why are they doing it after gold has rallied so much? I mean, they're getting a discount here on copper relative to that, but gold has had a pretty significant rally over the last couple of years, and they're willing to pay a premium of 30%, which is substantial for this entity. I think there's something brewing in gold land. I'm not a gold bug per se, but I think that we need to be really attentive to the pullbacks in the gold area, when we get those discounted days, because they do cycle back up pretty quickly and rally again. We got to watch that US dollar, of course, as that's going to be key to the whole basic materials group and commodities in general. But like even with an elevated dollar still, gold has performed really well. And you got to look at how has gold done on an inflation adjusted basis over the last 50 years, and it's not too bad actually, because of the decline of the purchasing power of the dollar. So keep that in mind. So yeah, I think there's something brewing here in the gold patch, and I'll pull up another chart, Dave, you can comment on. Let's see what we got here. So this is the first of some slides. This is the Q's performance for this mid-month. We're looking at mid-month performance is the key here.
Yeah, so for the month, the Qs are expected to do quite a bit better than the Spider, 1.73% for the month. But the mid-month seasonality is really robust for the Qs relative to the Spider.
Okay.
We're expected to do 1.01% for the Qs and 0.7% for the Spider. So a pretty good mid-month seasonality is expected.
Okay.
If you look at small caps as well, they're even better. The IWM is expected to do 1.67% relative to the 0.7 of the Spider. So small caps might have some legs this week, and again with the NASDAQ stocks as well.
Yeah, I mean, it is important to point out the NASDAQ in general because it's had the leadership. It's been strong, and a big part of that's been these mega caps. And as far as where we're at, I might as well just point that out. So for the week, we had the Dow Jones down 1.1%. NASDAQ was actually up for the week 0.4. S&P was down 0.3, and Russell was down 1.1. Now for the year to date, as of Friday, Dow Jones up a measly 0.5, NASDAQ up 17.4, S&P up 7.4, and Russell down minus 1.2. So the discounted ones are obviously the Dow and the Russell. The Russell might get resolved in a summer rally if things go well. I don't know. The Dow might get more resolved compared to the other ones if we have a real down cycle in the market where the Dow holds up better and then NASDAQ gives back, the gains that it's been trying to achieve this year so far. So that's kind of a consideration. Dave, you're going to have to comment on just these things that as they come up because they're not in any particular order. So anything else to add to that slide on the screen? If
no,
not, I'll just
expected in the small caps relative to.
Okay, here's the small cap one here. 1.67 versus 0.7 for mid-month seasonality, which mid-month seasonality is the 9th through 14th business day of the month. And so starting on Friday really is kind of the first day, but because of the way the week went and the numbers that we had on Friday, it put a Debbie Downer on that, and we really didn't get this launch. So I think we're looking into mid-month here starting on Monday. So I would give it a good run. And we culminate in Expiration Friday, which is still slightly positive, right?
Mm-hmm.
So let's just package the mid-month seasonality into Monday through Friday, finishing with the expiration event. Then the last 5 trading days start on the Wednesday, actually, because the 29th is a holiday, right?
Yeah.
So the last 5 trading days are split by a long weekend. And the last trading day of the month, for some reason, is softer historically. So keep that in mind. Okay, let's get to the next slide here. What do we got? Treasuries. Oh, we got something before that. Hold on, we got this here. Let's talk about this.
Yeah, this is the ETFs that are in mid-month seasonality is showing strength in things like biotech, XBI, and IDB. Also strength in the oils, USO and XOP, and strength in some of the high beta stuff, the ARKK, and also SMH and SOX. So that ties in with the NASDAQ strength as well. So and XLE. So strength in oils, strength in big beta tech, and even gold, the GDXJ, and a little more weakness in some of the defensive stuff, such as XLP and real estate. And the XRT is your retail ETF, so that might be a little bit weaker too. Depends, but this is going to be driven by earnings this week. It's going to be Home Depot, Target, and Walmart's going to dictate what happens with the XRT. So strength in oils, chips, high beta stuff. That's what that slide shows.
Well, let's look at this then. You can kind of see how everything's shaped up. So, like if you look at the year to date and so far for the month and then for the week, right? You can see how the communications even better than the Nasdaq overall, right? And Qs are just the Nasdaq 100, not the whole Nasdaq, so they're a little bit stronger. But again, the mega cap component there, and XLY because you have Tesla and Amazon in the XLY, right? So then on XLF, obviously, all the financials have been taking it on the chin. So there is argument sometimes for, these things to sort of swing back. But if there's really a terrible macro going on, it may take time for it to work itself out. So what you end up here is not this mean reverting, like not XLC coming down and XLF going up in that pure sense of mean reversion, but you get just volatility because you get these short squeeze type rallies and then it goes back down and then you get another squeeze and it goes back down, that kind of thing. And then this may just sort of taper off and not actually mean revert back down. It might just find a new level to trade in. So sometimes it's not the best to always be picking out the best performer and the worst performer and pairing them together looking for mean reversion. Sometimes it's better to operate, more in the noise area, not in the, in the extremes. So I found that especially when my pair traders were putting together, combinations of pairs for a portfolio, if they used the same methodology to select all the pairs, they eventually got themselves into a problem. Like if they used only a value composite to pick everything, then if it was sell value and buy growth, you were kind of taking it on the chin on all the pairs. So think about mixing it up a little bit. Don't always use the same measuring stick for everything that you do, because you could have really good performance or really bad performance instead of more of a, an average run rate, kind of a blended performance, volatility reduced. You want lower variance, right? So sometimes think about, what's possible in the middle and not always at the extremes. Does that make sense?
I've totally seen that. Always going.
I mean, yeah, absolutely. We've seen that. So bringing up crude oil here, again, the dollar strength putting a little bit of pressure on it, more so than we saw with the basic materials, just because of oil, has that growth implication as well. So, but we had a great reversal last week and we rallied off of that. And then it just kind of gave that back. So I'm looking for it to find, some solid support in here and have opportunities for rally. And if we can get some sentiment back on the table as far as the prospects for the world economy, oil could gain again. But it's certainly out of favor at the moment here. Let's find something else. You wanted to comment on anything on treasuries here? I mean,
No,
this is the 10-year.
yeah, we were pretty high at one point, but
Yeah,
I guess the thing is the bond market doesn't believe that the Fed can keep hiking rates higher or keep it higher
right,
for long, right? So that's what this
right.
showed.
So what else do we got here? Let's go to our, let's see, let's go to here. Let's take a look at the futures where we're at now here. So
Pretty flat.
yeah, everything. So across the board here, Dow, S&P, all kind of like not knowing what to do with itself. Maybe partly because that meeting for the debt ceiling was kicked down the road from Friday to sometime this week. Yeah, so nothing much going on there. Let's take a look at the VIX here because, we are in the lower threshold again around that 1850. And it looked like at one point we were going to head down towards kind of 15, but we didn't quite get there. But it's still fairly discounted, but it might stay, doing this chop thing. Of all the years that we looked at, when the VIX time tends to get lower, and it often is in the April to May time frame, and then picks up sometimes in the summer again. Okay, what else we got? Let's just take a look at gold since I was looking at it earlier. Here's gold, and you can see how that does seem to pull back and bounce again, staying really elevated. Let's look at it on the monthly. I mean, either there's a glass ceiling here, right? Or we're going to see once this gets through, if it can get through and clear this area, the prospects might be rather stunning. There have been some predictions that we'll see gold up at the 26 to 2800 level. That'd be fine. I just like looking for pullbacks on this, and I look at the current political state. I look at the concerns that are going on geopolitically, and war's not over, and currencies are under pressure, and I take a look at what's happening with the petrodollar, history and current reality, and I think that there's some pressure on the dollar, and if that happens to decline further, then that glass ceiling on that gold might get broken, and it might really do that rally. So anyway, that's my take on it. Dave, thank you for your time. Hopefully people have a good trading day next week. It is mid-month seasonality, culminating in Expiration Friday, so give it all you got, and we'll talk to you next week.
All right, good luck.